Finally, I bought a new van for my business. Congratulations! But it's a car. What? The dealer sold it to me as a van. The registration says van, and even the insurance says the same. That really doesn't matter for me. For tax purposes, it is a car. Wait, what? Let me help you clear up the confusion here. Recently, HMRC has introduced two important tax changes in relation to cars and vans that every accountant and business owner must be aware about. The first one is actually a good news, thumbs up. HMRC has increased the approved mileage allowance for the first time in many years. Second one, not so good. HMRC has changed how double cab pickup vans would be treated for tax purposes. And for some businesses, that could mean a significantly higher tax bill. In today's video, we will break down both of these updates and we will try to understand how it is going to impact you and your tax liability. So let's begin. Starting with the good news first, there has been increase in the approved mileage allowance after 15 years. Before even we jump into what the change has been and what the rates are, let us firstly understand what is approved mileage allowance. When you as an employee, sole trader or a director use your own personal vehicle for business travel, HMRC allows you to receive a tax-free mileage payment or claim tax relief based on the number of business miles that you are traveling for business purposes. Okay. Now, what is business purpose? Let's say as a director, you are going for client meeting, you are going for supplier meeting. So all are the things that you are doing for business purpose, but you are using your personal vehicle for that. Now, one important principle that we have seen from the starting and what HMRC believes is that you should only claim expenses which are wholly and exclusively for your business purpose. So for a director, using his own personal vehicle for personal purposes is not a matter of HMRC, right? We are only focused on the business miles that you have traveled. Okay, and that rate has been increased. So instead of keeping receipt for fuel, different repairs and maintenance, servicing, depreciation, and all that, HMRC has provided you a flat standard rate per business mile. So let me share my screen to show you the recent rates. So here we have the rates. So you can see approved mileage allowance rate. So this has came from HMRC's website. I have picked it up from there. The approved mileage allowance rate from tax year 2011 to 2026. It was same for 15 years. Now, this is dependent on the vehicle that you use. Either you own a car or van, you have motorcycle, or you have a bicycle. For the first 10,000 business miles in a tax year, you are able to claim 45 pence, 24 pence, and 20 pence based on the vehicle type. And when the business mile increases, okay, for cars and vans, they have reduced by 20 pence the business miles that you would have been able to claim. So higher you travel for business purposes, the lesser you are able to claim the mileage. Okay, so for motorcycles and bicycle, it is basically the same. Now, what has been the increase that I'm talking about? The increase has been for cars and vans where you are traveling for the first 10,000 business miles. Earlier, you would have been able to get reimbursement for 45 pence. Now you are able to get 55 pence. So that's about a 10 pence of increase. Everything else remains same. Okay. And over and about 10,000, it is still 25 pence. And for motorcycles and bicycle, it is completely the same. There has been no change. Let's understand by an example how this really impacts you. So let's say you are a director, you use Range Rover or any other luxury car for like that you own personally and you are also using for business purposes, and you traveled around 15,000 miles in the tax year 25-26. Okay. For the 10,000, for the first 10,000, earlier you would have been able to claim 45 pence, and now for the 5,000 and earlier the 5,000 ahead, the differential you would have been able to claim at 25 pence. Okay, here is the 25 pence that I'm talking about. So over 25 pence, the business miles would be claimed at 1.25 pence. So the total you would have been able to get from the company, the reimbursement you would have been able to get from the company was 5750. Okay. Now, coming to the new tax year where the change has been applicable, assuming the business mile remains same, everything else also remains same, just the one change, just one change. This has been now 55 pence. So you get 6750. So there has been increase in the reimbursement that you get from the company of £1,000 for the company. So firstly, as a director, you get higher reimbursement for the business miles that you have traveled. Okay, and for a company, you are able to save corporation tax based on the profit band that you fall into. Either it is 19%, 25%, or if you have marginal relief. Okay, it would be different. So assuming, let's say 20% of CT relief, you are able to save £200 as tax as a business. Okay, and the director gets £1,000 higher than the earlier approved rate. That is completely tax free for him. Okay, now what about the employee? As an employee, let's say your employer reimburses you 45 pence. Okay, now what HMRC will do, HMRC will provide you tax relief on the differential. Okay, HMRC will provide you the tax relief on the differential. You won't get the complete reimbursement, the cash. You won't get the complete cash reimbursement. You will be getting it in the face as a tax relief. Okay, so 45 pence, that is something that your employer has reimbursed on. But if so, let's say it was 5,000. Okay, so it would be 5,000 into 45 pence. This is something that employer has already reimbursed to you. But what what HMRC says now is that you should be able to get 55 pence. So how are you going to get the differential? The 10 pence of differential you would be able to claim as a tax relief. Okay, so 5,000 into 10, £500, and the tax relief, assuming you are a basic rate taxpayer, you would be able to get £100 of more as a tax relief, as a reduction in your tax amount. Okay, so this really helps you save your tax, and it isn't really that high, but it is still something that could help you save your tax liability in each tax year. Okay. Now let's move on to the second update, and unfortunately this one isn't good news. If you own or are planning to buy a double cab pickup through your business, HMRC has changed the way these vehicles are treated for direct tax purposes. For many years, qualifying double cab pickups were generally treated as vans, which came with certain tax advantages, which we are going to discuss and go through the calculation for. However, from 6th of April 2025, mostly newly acquired double cab pickups will now be treated as cars for direct tax purposes. Okay, this change is basically for direct tax purposes. And how did this change come upon? This one really affects two things majorly: capital allowances and benefit in kind. And also it affects the overall cost of owning the vehicle. Why did HMRC woke up and chose to change this particular thing? The answer lies in the famous court case that involved your favorite Coca-Cola. Okay, so Coca-Cola provided its crew member vehicles like now let's move on to the second update. And unfortunately, this one isn't a good news. If you own or planning to buy a double cab pickup through your business, HMRC has changed the way these vehicles are treated for direct tax purposes. For many years, qualifying double cab pickups were generally treated as vans, which came up with certain tax advantage. You have capital allowances and benefit in kind, by which you can consider the tax advantage of both of them. Okay, and the overall cost of owning both the vehicles. However, from 6th of April 2025, mostly newly acquired double cab pickups will now be treated as cars for direct tax purposes. So it is for direct tax, not for indirect tax. So the VAT claim is still the same. The way you are able to claim VAT on the purchases that you make for cars and vans are still the same. Okay, if the payload is less than 1 ton, the payload is less than 1 ton, it would be treated as cars, and it would be the tax input tax would be based on that. Okay, and if it is higher, it would be treated as a commercial vehicle. Okay, and again it would be having a input tax. Okay, it would be treated as a commercial vehicle. So why did HMRC suddenly change the rules? The answer lies in the court case, in a famous court case that involved Coca-Cola. Okay, Coca-Cola had provided crew cab vehicles to its employees and argued that they should be treated as vans because they had payload capacity that exceeded 1 ton. So this was the same rule that applied to the VAT. Okay, so for the VAT, if your payload exceeds 1 ton, you are able to qualify it as a van, and the capital and the VAT input VAT it was dependent upon that only. Okay. So Coca-Cola said that that exceeds 1 ton and it should be classified as a van. However, the court looked beyond the physical presence and the payload. They asked a different question, which was what was the vehicle primarily designed for? The vehicle seemed to be designed for carrying both the passengers and goods as well. There was no clear predominance of this would only be helpful to carry goods. Normally, the general purpose of vans would be to carry goods, and for cars, it would be to have carrying passengers. Okay, but it has both the purposes served. Okay, the vehicle was designed to serve both the purposes, but since there wasn't any clear predominance that you would be using that for carrying goods, the court concluded that they should be treated as a car, not a van. From that decision, HMRC has updated its guidance from 6th of April 2025, meaning that many double cab pickups would now be treated as cars for direct tax purposes. So to understand why these changes matter, imagine you own a limited company and you have just bought a 60,000 pound of Ford Ranger. Under the old rules, your accountant would probably be smiling. Under the new rules, maybe not. Why? Let us see in our Excel. Let me share my screen. I'll help you understand how this change affects you. So car or a van, what is the discussion? What is the discussion here? Car or a van? So this kind of vehicles you see in the image are known as double cab pickups. They have 2 rows of seats, 1 and 2, okay, and can usually carry 5 passengers, and then they have open cargo bed at the back where you can have a physical capacity, you can carry goods. Okay. Traditionally, if you had a physical payload of at least 1 ton, they would be treated as van for most direct tax purposes. However, HMRC's classification is based on how the vehicle is constructed and its primary design purpose, not simply on what the dealer calls and how you choose to use it. Okay, so let's say this double cab pickup van. Okay, I use it to carry goods. Okay, but still it would be based on how the vehicle is constructed, how it's primarily designed as the purpose. Okay, so it would not be based on what your dealer says or how you choose to use it. How do you have a distinction between a van or a cab pickup? So normally a van has 1 row of seats. You have a large enclosed cargo area. Okay, that is almost packed up. You have no doors there, and it is mainly used to transport goods. Okay, let me show you one van like this. Yeah, so this is a van. You have closed door. Okay, this is completely blocked to have goods. You can just carry goods here, and here you have 2 seats. Okay, in the front. You don't have another one at the back. Okay, this one has the separate partition, and after that you are just able to pick up and carry goods here. Okay, this is a general example of van, and you can clearly qualify it as a van. And car also, you know how it looks like, but the but the problem is with the double cab pickup vans. Okay, for a double cab pickup, there are two rows of seats. As I said, you can carry 5 passengers. You have load bed at the rear end, and it is built to carry both passengers and goods. Now, what I was talking about regarding Coca-Cola is that you can see here you have door, right? You have door. Firstly, the first row. You have second row, I think, which can be used to have passengers. Okay, and you can also have goods stored here in transport. Okay, but it does not seem that it is completely for carrying goods. Okay, so before even you consider buying such cars and vans, okay, you need to consult your tax advisor, and you need to see the differentiations before even you buy in, because the tax impact are really different for both of them. Okay, why does it really matter to consider it? Okay, there are two things that I'm going to discuss today. First is regarding capital allowance. With the capital allowance part, for a car or a van, the capital allowance claim is totally different. How? For a van, if your double cab pickup van is a van, okay, earlier, based on the earlier definition, you would have been able to claim a capital allowance, that is annual investment allowance at 100% flat on the first year. Okay, in the first year only you are able to claim 100% AIA, no need to wait for future years. But for cars, things are really different. You are only able to claim written down allowances. Written down allowances at 6% or 18% based on the emission of the car. Okay, so let me go through the calculation. Let's say I purchased 60,000 pound, considering the same example that I said you now. You have purchased a new car, double cab pickup van, and earlier, as per the earlier rules, if there wasn't any classification and HMRC did not choose to change this thing, you would have been able to claim AIA flat at 60,000 pound. That would qualify as a van. Okay, but now if your double cab pickup van qualifies as a car, based on HMRC's eyes, not what your dealer says, you are only able to claim, let's say it is a higher emission car, you would be able to claim 6% on the first year. Okay, 6% on the first year. Now let me show you the distinction between them. Okay, in the first year, when you purchased the van or a car, you would have been able to get 60,000 pound. Okay, 60,000 pound as the tax relief. So now you are just able to get 3,600 pound in the first year. That's a huge cash flow difference. Assuming you have a business profit of, let's say 80,000 pound, yeah, and you purchased a vehicle over which you get a capital allowance, you're taxable. This is after the adjustment of depreciations and all that. Okay, so what you would do is 80,000 minus 60,000, you have 20,000 left, on which you are a small rate taxpayer. So you would be having a payment of at the rate 90% based on the corporation tax rate that is currently applicable. But now, because of this change, the 80,000 would now be reduced by just 3,600. Okay. This 80,000 above that is after removing the depreciation. Okay, assuming it has been removed, depreciation has been removed, because when you deduct capital allowances, when you are getting capital allowance, you have to add back the depreciation. Okay, you have to add back the depreciation on the profit. Okay, so now you are going to pay tax on 76,400. Did you see the difference? Okay, you will fall into main rate, plus you will not the main rate, you will get the 25% tax, but you are able to claim marginal relief on that. But it is still do you see the difference? You would have been able to just claim the whole amount in the first year at the rate 19%. You are going to pay tax at 20,000 pound. Now you are going to pay 76,400 20 at the rate 25% less the marginal relief that you are going to get. So this is a huge cash flow difference. Assume it, just think of it. Now this 3,600 you will get each. It's not like that you will not get full allowance. You will get full allowance until and unless it goes to zero. You are able to claim each and every year. It is able to reduce your profit each year. but you should think about the cash flow part. You will be able to recover something that was that you were able to claim in the day one, in the year one, easily, completely. Now you are only able to claim at the rate 6% each year. So that would take around 30 to 40 years for this particular car in our example to claim the cost back and as a tax relief. So that's a huge change. Another one is benefit in kind. What is benefit in kind? So if you as a business owner is using the just for an example, if a business owner is using the van or a car for its personal for his personal use, okay, so you would be getting benefit in kind charge, okay, because you are using something that is not your own. You are using company's vehicle. So if it was a van, you have a flat taxable benefit, that is 4170 as per tax year 2627. Here are the rates. Here are the rates. So for 2627, it is 4170. So 4170 would be the benefit in kind charge. That would be the taxable benefit. So if assuming that you are in the basic rate band, you are going to pay 20% on it, and the company again is going to pay 15% as employer NIC, although that is deductible for corporation tax purposes. But the total tax that you would incur would be 1437 pound. Okay, the income tax for the director and the employer NIC that the company is going to pay. Okay, you are obviously going to get the relief as a deduction when you are getting your corporation tax. You are able to get a tax reducer of 20%, 19 to 25% is based on your profits. That is something that I'm not considering right now. But for cars, the things totally change. For cars, the taxable benefit is calculated based on the list price and on the CO2 emission. So let's say your list price is 60,000, as I said in the above example, 60,000 into, let's say, your CO2 emission rate. So this again you need to check based on your particular car and your specification. So assuming it is 37%, the taxable benefit is what? It is 22,000. Do you see? The taxable benefit was 4,000 when it was classified as a van. But if you use the car, okay, double cab pickup van that has now been qualified as a car, irrespective of what you are using for. If you are using it for personal purposes, the taxable benefit that you are going to get is 22,200. Do you see? It is about 5x of the taxable benefit that you are getting on the vans. Okay, so the tax burden would be at the rate 20%, assuming the same basic rate calculation. So it would be 4,440 pound, and on the top of that, you are going to pay employer NIC as a business. So it would be 7,770. Do you see? The tax burden again increases by 6,333. So one thing is you are able to get the capital allowances at a lower pace, and you are going to have a higher benefit in kind charge. Okay, so these are the two major changes. Now talking about the transition, when this is going to apply. Okay, so you are still going to get the old tax treatment if you have a vehicle that is purchased before 6th of April 2025. Okay, or it is 1 April 2025 for corporation tax purposes. You already own that vehicle, or you entered into a binding contract to purchase, lease, or order the vehicle. Okay, so fortunately, HMRC has introduced transitional relief to soften the impact of this change. So if you have already the vehicle being owned as a qualifying double cab pickup, or you have entered into binding contract before the new rules came into place, you can generally continue applying the same old van treatment. There is no need to change. However, this isn't permanent. Okay, it ends when you sell the vehicle, your lease expires, or on 5th of April 2029, whichever is earlier for income tax purposes, and for 31st March 2029 for corporation tax purposes. So whichever happens first. So any replacement vehicle that you are acquiring after that will be generally subject to the new rules that we discussed now. And you are going to bear the reduction in capital allowances and also the benefit in kind charge, which is typically higher for cars. So I hope this video is clear to you. We discussed both the increase in one good news, that was increase in the mileage allowance, and how it benefits you, and we also discussed on how this disadvantage of not being treated as a bank works for your business. So I hope this video helped out some people, and if it did, do like this video, share it with someone who might need to know. Okay, so thank you. We'll meet in the next video soon. Thank you, and keep watching, keep sharing, keep subscribing.